Hey, Inspired Moneymaker. Today we're talking all about entrepreneurship and a unique way of funding promising e-commerce founders. Episode 226 features Charlie Feng, co-founder of Clearco and angel investor.
It's very much about the fundamental unit economics, like the economics of the business. A dollar comes in, how many dollars comes out, right? And we piece that together with kind of all the data integrations we have. And as a result, we're able to kind of fund these businesses. And kind of a byproduct that we've seen over the years that's been something that we kind of lean more into is the diversity of founders as a result that we end up funding. Because we don't kind of, again, look at the pitch deck or kind of take intros in any way. We fund 8x more women than kind of the traditional venture capital space, and we've like 30% of our portfolio are BIPOC founders.
I'm Andy Wong, host of the Inspired Money podcast and financial advisor at Runnymede Capital Management. Our guest is Charlie Feng, who has worked behind the scenes at Clearco, building teams and products. He's less visible than his fellow co-founders, Andrew D'Souza, who serves as CEO, and President Michelle Romanow. If you're in Canada, I'm sure you know Michelle is the youngest cast member of the Canadian reality TV series Dragon Den, a show that has inspired Shark Tank here in the US. Clearco is one of the top startups in Canada, a fintech company that uses AI to democratize access to capital. Clearco has invested more than $2.5 billion in over 6,500 businesses in 7 countries. Its approach is unique. Its investments range from $10,000 to $10 million and are paid back via a revenue share agreement plus a flat fee of 6 to 12%. Recipients maintain 100% ownership and control. It's also worth noting that Clearco's AI approach has resulted in funding 25 times more women-owned businesses than traditional venture capital. In this episode, you'll learn about challenges that entrepreneurs have fundraising, the differences between venture capital, and Clearco's data-driven approach. And stay tuned to the end for tips on hiring yourself out of a job so you can find your replacement and move on to new projects. Now let's get inspired with Charlie Feng. Charlie, welcome to Inspired Money. I'm so excited to have you on the show.
So, pleasure's all mine. Thanks for having me, Andy.
Let's jump right in. What's your earliest childhood memory of money?
That is a good question. Two memories really come to mind when I think of that. One is, so I'm a first-generation immigrant. My parents brought me here when I was 7 or so. And one of the first kind of memories was, we're dead center, kind of middle class, and we were very frugal kind of growing up. So I still remember when we would always do the price matching for anything in the grocery stores. And we would kind of take a bus for 20 to 30 minutes just because the bananas were cheaper by 4 cents in one than the other. That was probably the first very strong memory that's kind of stuck to me. The second one is probably related to when I kind of got a first taste, because I guess growing up from an Asian household, allowances for some reason wasn't really a thing. So I didn't really get to touch or use money up until kind of much later when I had my first kind of like paper route job, if you will, and earned a bit from that.
With the price matching, growing up with that, is that something that you carry with you, or is that something that you eventually like let go and said, all right, I don't need to do that anymore?
Yeah, I don't think I don't price match anymore. I don't kind of go around shopping for the cheapest bananas, but I do find myself still very much of the frugal mindset. Like I don't go out of my way to find compare kind of flyers for that particular case. But very much my head is always thinking about, for example, even if I were to have a house, instead of living in myself, and I'm like, I could kind of arbitrage that by renting somewhere cheaper, I would do that any day of the week. So very much that's still kind of in my first thing I think about. When I think about a car, I think about a depreciating asset. And I'm like, So that's still very much how I think about things.
So money's on your mind.
Yes, very much so.
So growing up in this middle-class immigrant family, Did you ever imagine becoming an entrepreneur or founding a fast-growing startup?
Never. Not until I didn't even know startup was a startup where entrepreneurship was a possible career path or something you could like spend your life doing. Up until probably my first taste of it was my junior year in college. I think up until that. So growing up, both of my parents work in the government. They've been, worked really hard their whole lives. Same job for the last 20 plus years, right? So very much my mentality growing up was that more traditional, find a stable job, get a good income, buy a house, that kind of mindset. And yeah, didn't think about entrepreneurship, didn't know I didn't know better until my junior year of college.
When did that start to change? I mean, or how did that start to change?
I think it was very serendipitous. And I have a lot of people along the way to thank for. And in particular, it was kind of that, whether it's peers of mine or people I looked up to who might have been a few years older than me or might have been a decade older than me, that kind of people I look up to as mentors or people I want to emulate. And I think it made me start to realize that, that they were doing something like that, like they were building a company of their own, and that's something that's possible. And B, that a lot of things, I think this is a Steve Jobs quote, but a lot of things that we see around us are just made by other people, right? It's not like it kind of came out of thin air, or it was invented, it was created, it was built by other people. And I've always kind of been someone that liked building or tinkering with things. So kind of learned coding on my own as a kid, learned to build my own websites. I just didn't know that could be applied to any sort of career or making money out of it too much later. Any
clues of this interest in business as a kid? Like, were you selling candy or anything?
I was much more of a builder. So I remember when one of my early memories of kind of coding something up or building something was love video games. I still play a lot of video games, but growing up in a strict Asian family, I was not allowed to play video games. So I always tried to figure out ways that I could. So my first kind of reason to program was I programmed a bot that helped me play video games when I was at school. So I would leave the computer on running and play video games for me, and I go to school pretending I didn't play video games, or my parents wouldn't find out. And a lot of these kind of tinkering or things that I built more for fun became kind of my semblance. So I guess a lot of what I do, even in building business, is that 0 to 1 thing, kind of finding a problem set and kind of building the product or figuring out what is the product that could be a potential solution for it. So very much less of the money-making side, but more of the how do I build something to solve this?
Yeah, you're always trying to solve a problem. Now, were you a professional gamer for a while?
Very briefly, my first year of college, and then I realized my GPA really took a hit, and I had to stop that. But it was something that I played a lot of video games growing up. Very much wanted to get a sponsor, kind of see what that's like. And my first taste of freedom going to college, I was like, oh, I could do this. My parents aren't watching over my shoulders. I tried it out. It was, I guess I've come to appreciate a lot more of just professional. I had that understanding when it came to sports, but video games was something that I did for fun. But I have come to appreciation after that experience of just the hard work, all those kind of professional players, whether it's Fortnite or kind of Dota or StarCraft, put in. Because once it became kind of a real job or something professional, the practices were mandatory. Things became a lot less fun, if you will, to become, I guess, mandatory, right? So I came to appreciate that a lot more, or that aspect.
But you could make money doing that while you were in school.
At that time, it's not as the video gaming space was not as robust as it is today. So it was less about making money, but it was more like, you could get kind of a free computer or a free laptop, that kind of stuff.
Yeah.
But yes, some sort like that.
Well, that's meaningful for a student for sure.
That's right.
It's funny. Yeah, it reminds me a little bit about, I read Andre Agassi's book, and he was very open about he hated tennis, even though he was one of the greatest. And then years later, when he married Steffi Graf, and he told her, like he confessed to her, I hate tennis. And her answer was, don't we all?
I remember reading that book. Andre Agassi, I played tennis kind of as in high school, and Andre Agassi was definitely one of my idols or someone I looked up to. So when I read that book, a lot of things was very interesting and a lot of strong takeaways there.
So Clearco is an amazing growth story. Tell us about how a small group of founders came together, even living in the same house.
Yeah, it was. I have to give credit to my other two co-founders, Andrew and Michelle. They kind of pulled the gang together. But we were all kind of repeat founders, and so some more successful than others, and very different set of experiences. So some of us had bootstrapped companies, others had kind of raised the traditional kind of venture capital routes. And when we started talking about building companies, a couple of things really came to light. One was the fact that nobody really starts a business to fundraise, right? So they usually start a business so you could serve your customers or build a product or do something that you want to do. And then you realize that, 6 months a year, you're on the road pitching investors, right? And it's not something people want to do. And secondly is that it's frankly pretty tough, right? You have to know the right people, have the right connections. And it's a common thing in the kind of the VC space that you need to know a intro to an investor. Cold emailing is not the right answer, or it doesn't really work. So that's something that we kind of all had a passion for, of how can we better help fund the next generation of founders? How can we help enable founders and democratize capital, if you will? So we started the company in San Francisco, down in the States, but we were all Canadians, so we moved back up to Canada eventually. But now it's all remote since 2020.
What is the cliff notes of each founder's experience? Since you mentioned different paths, and I'm curious about different skill sets too.
Yeah, so I think the Clearco, or what we built, had an interesting. It required an interesting overlap of different skill sets. So one of my co-founders is very strong in kind of the fundraising, the traditional venture fundraising side.
Is that Andrew?
That's Andrew. Michelle, on the other hand, have bootstrapped and scaled multiple businesses and exited businesses on that side. So I very much had that perspective, and also kind of seen a lot of companies on Dragon's Den. She's seen a lot of these businesses that were great fundamental businesses, but just not a great fit for the traditional venture model. It doesn't have that 1,000x that Airbnb or Coinbase could be. And my other two co-founders, we had one that was very strong on the kind of data statistics, econometrics, and kind of capital market side. And then another person who was very strong on the product side. And I kind of sat somewhere in between finance, more traditional kind of credit rating and finance space, and data. So it was interesting because it almost required a founding team, I think, that needed overlapping skill set between finance, product, kind of tech, and data to build a product of what we did.
Yeah, I saw that, Michelle, you mentioned Dragon's Den. And for us here in the US who may not be familiar, that I've seen it referred to as Canada's Shark Tank. And I think that she sold a company to Groupon.
That's right.
So that's pretty cool. Today, Clearco has invested, I saw on the website, $2.5 billion, funding over 6,500 businesses in 7 countries. It's a really exciting story. How much time took place since like the end of 2015 until that became like the mission? Because I know that there have been different iterations and the business changed.
Yeah, most definitely. And I think for anyone who's kind of thinking about entrepreneurship or thinking about a startup, it's definitely not a straight line, had a lot of kind of windy paths. And for us, we always knew that we wanted to help kind of enable or democratize capital, kind of somewhere in that veins, like help founders. How can we enable the next generation of founders? But what product exactly are we building, and exactly who are these founders? Because founders is a very broad term, right? It ranges anywhere from someone in the creator space who's on YouTube or making content, all the way to someone who's kind of deep technology, kind of trying to make it Moderna, right? Or trying to make the next kind of cure for cancer. And we took a lot of iterations at that. So it wasn't until probably 2 to 3 years in where we kind of figured out that we cracked it, that the e-commerce space had a great fit for what we're building, and specifically around the type of founders that need capital to scale their business. Once they kind of figured out the fundamental unit economics of the company, and they realized that they just need to pour essentially gasoline on the fire. And traditionally, that's still done with venture capital, where 40% of VC dollars goes into marketing. So they just go straight to Google and Facebook, right? And we were, in our eyes, that's much better spent in a non-dilutive fashion.
You guys started in Silicon Valley, like it's like the heart of VC land. Like so many startups get funded in Silicon Valley. Were there sort of problems were there shortcomings that you saw that you identified that you had a solution for? What problem were you trying to solve?
Yeah, the main problem were initially, I guess, when we started the company, it was the broader kind of mission or idea that there were a lot of great founders out there that just weren't in Silicon Valley, right? Or weren't connected to the right circles. So like in Canada, you kind of need to be in whether it's Toronto, Montreal, Vancouver. There's a few big cities, right? Or Ottawa is starting to become more of a bigger city, right? Like there's a few of these larger cities, whether it's the US, New York, right? Silicon Valley. And for the founders who are just not plugged into these venture or investor ecosystems, it becomes a much tougher game, if you will, to access capital. So that's kind of one lens that we really thought about from a mission perspective. And then number two, it was when we realized kind of that statistic around the fact that such a high percentage of every dollar that people raise and give up their equity for. So you give up, 20, 30% of your company, you raise a chunk of money, and then you kind of turn around and spend most of that money, 40% of it, to Google and Facebook because you need to scale and grow your business for good reasons. And we just thought that was a very inefficient way of using capital. There's kind of got to be a better way, if you will. So,
yeah, let's talk about that because it really raises the idea of use of capital. Like, what are you using the money for? And then as a founder of a business, how are you accessing that money? Are you doing it through equity? Are you doing it through debt? And what are the expectations as far as what are you giving up, right, for that money and how to apply it? So what's kind of the thinking as far as a business owner, should I sell equity? Where should I be allocating those dollars versus what you guys identified? A lot of e-commerce businesses were really needing money for marketing and I think inventory. And maybe they shouldn't be giving up 30% of their company for that type of money.
Yeah. We think of capital allocation or the best use of capital, like you said, as a cash flow matching exercise. So if you think about kind of the corporate finance function or the finance function of any company, finance is effectively trying to figure out the right instrument to match cash inflows and cash outflows, right? You have, let's say, so if you're doing a heavy R&D project, you have cash outflow. You're paying salaries, you're doing R&D investment for probably a number of years until you get a payout, 10 years later. That is probably something where equity capital makes a lot of sense. It's risk capital. It's capital where you're investing in R&D, and who knows 10 years later if you're going to get something or not, right? And that's where equity capital makes a lot of sense. When you're looking at, for example, Facebook marketing, or if you're looking at inventory, like you mentioned, it kind of begs the question of, is that still the best way to fund that use of that need of capital? And for example, for most marketing exercises, it's usually kind of a 30 to 90 day turnaround. Like you put your money into Facebook, 30 days later, or even sooner than that sometimes, well, you'll get the customers coming in from Facebook, and they'll pay, they'll buy whatever e-commerce product you're selling. And in those cases, well, depending on how short it is, sometimes you can even use a credit card, right? You just don't even need Clearco. You don't even need alternative financing. And then you have kind of the stuff in the middle, right? For example, you buy inventory, and that inventory is going to sit in your warehouse for 6 months, right? It's probably too long for a credit card, right? That's very high interest rate you'd be paying. But it's also probably too short for kind of a true equity-like capital. So I think the current kind of ecosystem when it comes to kind of money, the good thing about capital is that it's fungible at the end of the day. But I believe that we're going to see a lot more different types of alternative kind of instruments to fund different uses of proceeds. And we're starting to see a bit of that. We have a few companies that's doing kind of inventory capital funding specifically. We do inventory and marketing. There's ones that's technically even shorter terms, kind of like the Brex, the credit cards of the world. And we're seeing a whole spectrum, which is very, very encouraging to see.
Can you talk a little bit about how the idea was born for this structure? And I'm also curious, like, how much pushback did you guys get on this idea of giving money to small businesses? One, many of them have little history, and two, you do not have an ability to collect on their personal or business assets.
That's right. It was very tough, and I'm one of the things that's very encouraging for us nowadays is that we're starting to see a lot more Clearco for a different industry or Clearco for a different geography. And that's very encouraging to us because it means that the broader community is starting to accept it, right? Like the fact that we funded $2.5 billion is a large number, but it's still very tiny in the grand scheme of kind of financing, right? Or inventory, like any way you slice and dice finance, 2.5 is like a tiny sliver in the grand scheme of things. So in order to actually start to really move the industry, we like that, the fact that other players are starting to see it, or it's encouraging to see that. And for us, the question around kind of, the question really became, what gives us enough confidence that this business is, we're going to get our money back, right? Like you said, we can't, it's not personally guaranteed. It's not secured against their assets. We can't go collect on it. It's purely based on the revenue, the future revenue of these businesses. And the main reason we kind of arrived at this conclusion is because what we realize is that there's a gap in the market where a lot more businesses nowadays are being, the future of businesses that we see are becoming more digital businesses, right? They're businesses that doesn't have an oven or a factory that you can kind of collateralize against. And by definition, these digital businesses are asset light. They don't have these things you can collateralize against. Yet, what we see kind of as a pro or as a feature of that business, the fact that they're asset light is actually being penalized in the traditional system of saying, well, that means you don't have assets to collateralize against. And that's kind of when we realized that, wait, revenue, these businesses, while they don't have something tangible today, what they do is actually they do have something very tangible in terms of their customer base and the product they're selling. And based on the data we could see, that doesn't really show up on their financial statements as much, you could kind of start to have pretty strong confidence of whether you'll see those revenues repeat themselves next month or the month after, and so on. And the way we get these data points is we connect to their first-party data sources. So we connect to the Shopifys, we connect to the Stripes, we connect to the Googles, we connect to the Amazons. And these are raw data that we get, data feeds. We get first-party data that can't be altered, that can't be manipulated in any way. And they are raw data of this customer buys this thing at this time, right? And it's very powerful data since you get so much of it, and you can start to get a very full understanding of how to essentially get a piece together what this business is really like, kind of from a ground up.
So the benefit to the founder is that they're not taking on debt for their business. If they don't pay you back, they're not going to go bankrupt.
That's
you
right.
guys are taking that financial risk?
That's right. We're taking on a different type of risk. Very, 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 I guess it's not debt. It's not quite equity either. It's revenue-based financing. So it is still a liability, I guess, right? It is still something they have to pay, or they don't have to pay back, but a portion of their future revenues will need to pay it back. But the advantage for the founder, for example, is if their business goes under, hopefully, but for example, takes a dip. Could be due to seasonality, could be due to 2020. We had this actually happen to us, right? In start of 2020, now e-commerce is doing really well, but start of 2020, it wasn't, right? It was the pandemic hit, COVID-19, and all of our customers their revenues tanked, for lack of better words. And in the traditional system, we would have, if this was traditional debt, the banks would have asked we still need to pay our money back, right? A loan's a loan. In our case, because it's a revenue share and revenue-based financing, if the revenue dips, we just collect less money, right? And in that kind of sense, our incentives are very much aligned with the company of that, when things are doing well, we're happy, they're happy. When things are doing poorly, well, I guess we're both in it together.
Yeah, certainly your incentives are aligned, and it's in your best interest to be helping those business owners through advice, through networking, because that comes back to you through the revenue share. It's a very data-driven approach. I don't know if you would call that AI or what the analysis process or evaluation process, what you call that. My guess is that also gets iterated many times. How did the initial cohorts go, and were there times when you lost money and then you need to course correct to evolve the process?
Yeah, I think this is a quote said by Max Levchin of Feng, one of the PayPal folks, and he said that in the credit business, or in the business kind of like a firm, you have to almost put capital at risk to learn your lessons, and that was the same for us. A lot of the early lessons were hard-earned lessons. We did lose money. Not every cohort went well, but I think the important part is that as we're getting there's two things that is very helpful as we move forward. One is, even at the early days, it was encouraging for us because we were able to improve. Even though we lost money for some of our earlier cohorts, we kind of identify, it's because we forgot about this element, or we didn't think about this feature. And then we add that in, you see the model improves a little bit. You might still be losing a little bit of money, but those incremental improvements really gave us confidence that this is a path that we can eventually get to a state where we believe that the probability of default, or the risk we're taking on, is actually less than traditional loans. And now we've gotten to that state where our risk is actually lower than kind of industry standards. And it's very much based on kind of a lot of data and AI models that we use to kind of predict what the future revenues of this business will do. Try to better understand how will this business fare in the landscape among its peers and other businesses. And like you said, Andy, I mentioned earlier, because it's in our incentive to help these businesses, we also kind of invest or put a lot of effort into building products that can actually help our customers make more money, right? Because we do it because it helps us too, right? So the incentives are very much aligned there.
It's a fascinating story. What are some of those industry metrics? Like, what's expected for profit versus loss in controlling that risk? What is industry average?
Yeah, it kind of changes for depending on kind of what subsegment you're looking at. So I think Lending Club has their data published online. I think they're around kind of 7%. If you look at kind of more asset-backed loans that are personally guaranteed, you get lower to kind of a 2% ratio or 3%. That's kind of what the industry is currently looking at.
Can you talk a little bit about the expected trajectory of some of these e-commerce businesses? Because my understanding is that there is a difference between what you're doing and traditional VC also. Let me ask you this, what kind of rate of return are you looking for? Because I think it's different than traditional VC, where the hope might be like a 10x or 100x the investment.
Yeah, I think Michelle had a great example, one of my co-founders, the Canadian version of Shark Tank, where she was looking at a business that sold kind of, iPhone cases, right? These nice wooden cases, they were selling very well. But it's probably not a business that's going to become the next Airbnb, right? Like they were selling hundreds of thousands of dollars. They're probably going to sell millions of dollars, right? But it's probably not going to become billions of dollars of iPhone cases. So you don't get that kind of 1,000x return that VCs almost need for their investment to return the fund, if you will. While for us, because we're looking at much shorter kind of investment cycles, we're not looking for anything like that. We're just looking for essentially a flat fee. So that's, again, kind of why the incentives are aligned, because the way we charge, where we make our money is, let's say we give a company $100,000, right? We charge 6%. So what that means is we make $6,000, right? Now the question is just more so, do we make that $6,000 in 6 months, or do we make that $6,000 in 8 months? And we hope we make it in 6 months, because that just means that, well, with the kind of the machine we built, it just means we can redeploy that capital somewhere else, and it's a higher, APR as a result. But if the company isn't doing as well as we thought it would, well, it might take 8 months, might take 12 months, right? And that's kind of the difference.
I understand that you do some angel investing yourself. How similar do you approach investing your own money versus what you're doing at Clearco?
Quite differently. And I think having been building Clearco for the last 6 years, or having gone through that, has really changed my perspective in terms of kind of what kind of businesses I want to put money behind from an angel investment perspective. I still believe, and we have a lot of, with Clearco has a lot of tight partnerships with, whether it's with venture capital companies or kind of VCs out there. And it's because there is a need for true risk capital, right? Businesses who are developing a new product, something that doesn't exist before. Like, for example, if someone started Airbnb again, right, or Coinbase, they would not be a good candidate for Clearco. There's not enough revenue in the early days. It requires so much momentum that you have to build before you kind of get that significant amount of capital. And it just wouldn't fit our current models that we have. But if you're selling, for example, weighted blankets, or if you're selling apparel, that could be a very good fit. And what it made me kind of more conscious of as an angel investor is I'm trying to spend both my capital as well as my time on companies where I believe that I could add some degree of value to. So usually these end up being somewhere in the fintech space, somewhere in the space of potentially AI or capital lending related.
At Clearco, it sounds like a relatively safe type of investment. My guess is that you're looking for the concept has already been proven out. Their sales, their revenues, hopefully it's profitable, and the company just needs like an infusion of money to scale. And what kind of metrics do you look for in your evaluation? Because maybe you can talk a little bit about the 20-minute term sheet, because it's a very unique approach.
That's right. When it comes to Clearco, the difference between a traditional angel investment is that a lot of times when I think about the angel investments I'm making, I'm betting on the founders or the teams or the kind of the new product or innovation that they're thinking about for their space, that I'm not expecting a return for multiple years, right? And for Clearco, it's very much the reverse of that, where it's looking at not really the teams. It's not looking at how fancy the pitch deck is and who they know. It's really about the data. It's really about, for every dollar that they make or for every dollar that they spend, how much can they make? So it's very much about the fundamental unit economics or the economics of the business. A dollar comes in, how many dollars comes out, right? And we piece that together with kind of all the data integrations we have. And as a result, we're able to kind of fund these businesses. And kind of a byproduct that we've seen over the years, that's been something that we kind of lean more into, is the diversity of founders as a result that we end up funding. Because we don't kind of, again, look at the pitch deck or kind of take intros in any way. The we fund 8x more women than kind of the traditional venture capital space, and we've like 30% of our portfolio are BIPOC founders. So a lot of the I think as a byproduct, the diversity of founders in our portfolio has been something that in hindsight, been kind of more obvious, but it's been something very encouraging for us in this space.
That's part of the big opportunity, right? Because at the outset of our talk, and you're talking about as a kid trying to arbitrage, like you're really trying to arbitrage geographically, like find these opportunities. There are business owners who they don't have access to capital in New York City or in Silicon Valley.
That's right.
But they're there, and there's a great business opportunity to be had.
Yeah, and I still believe that the best founders are those that are closest to whatever problem they're solving, right? Something that close to their heart. And especially for a lot of these e-commerce products, whether it's a certain kind of line of clothing, or it's kind of sometimes a specific gadget that is targeted towards a certain demographic. Oftentimes, we find that the best founders for those are the ones that might live in the region. Or if thinking about the one I saw recently is it's like a kind of like a nightlight, but it's a heater. So you plug it into the wall and it heats up the room. And it's something that I don't really have that problem, but people who are kind of living maybe perhaps further north, they have that problem. Those are the right founders to tackle that. So I believe a lot of founder market fit. And most of those founders don't live in Silicon Valley, right? Or don't live in those large metropolitan cities. And as a result, they're naturally not connected to the right investor bases. But yet they built a product that their community needs, or a community or a demographic really cares about. And it's almost a shame that they don't get funded, right? So that's exactly as you said, Andy. I think that arbitraging essentially the demographic and the geographic of different types of founders all over the world is our goal.
Yeah, and interestingly, I think when it comes to e-commerce, especially, once you have a local market, you also have a greater market than beyond your locality too. You can grow much bigger just because of the nature of e-commerce.
Yeah, and I think that's one of the advantages of e-commerce, but also kind of a lot of the new tools that Clearco is working on, really centered around how can we help founders sell their products across different geographies. Because like you said, by definition, e-commerce is almost borderless, right? You don't have to be in a certain location. Yet when you think about the financial infrastructures, if you want to actually sell in Belgium or the UK, yes, technically you sell there, but how do you deal with the shipping? How do you deal with the financial, how do you get a UK bank account? A lot of these things are actually currently barriers for founders. And those are things that Clearco is now working on to try to solve.
What are some of those products and evolution of things that you can offer your funded businesses?
Yeah, I think right now it goes back to kind of that previous we previously discussed around because our incentives are so well aligned with the founders, we just want them to grow, right? Because if their business grows, it's net good for us, almost fairly directly. So our incentives are very much aligned in that regard. Because it is, a lot of our products that are being developed now is around it's around payments, and it's around giving people access to not only capital, but access to other parts that they don't traditionally have access to. So that might be the access to the right vendors, the right know-how, the right partners to help them continue to scale their business. And when we're thinking about even infrastructure builds, it's very much tied into, for example, being able to open a UK bank account, getting access to another geography that you traditionally would not be able to because you don't have the right UK corporations or permits to do so.
With the businesses that you fund and work with, do you find that it's a one-time, funding, or do they come back for more?
Yeah, it's mostly always kind of more. So these are relationships we're looking to build, and because the capital we are giving people are generally speaking for marketing or inventory, that's kind of one cycle at a time. If it works well, their business keeps growing, it usually kind of repeats. And people come back for the next inventory purchase as they continue to grow and scale. And I think I think that's kind of a lot of what we're looking forward to, is to build those relationships with the founders as they kind of grow their business, and help those founders all the way from the start of their business all the way to where they exit the business. So we also are working on things that are helping companies, for example, sell their business or figure out they've reached a point where, as the founder, whatever their end goal is, we help them in that, whether it's wealth management or whether it's exiting the business.
Can you talk a little bit about how you've been able to navigate leading this company as it scaled from a handful of founders to, I think you're over 1,000 employees today?
Yeah, getting close to there. I think we're around 600-700 now, but we're getting close to that number. And I think the answer is that it changes a lot, right? And I think I'm still learning. I'm still quite young and learning as kind of a leader myself. The parts that we had to change over the years. So when we started the company, we were kind of the 5 of us, a few more, kind of living in a house, kind of living and breathing the product, if you will, right? And then as the company grew, we got an office and we kind of expanded. And today we've gone full remote. And we had to make that hard change where we used to be very much an in-house or in-person culture to a fully remote culture where we have different executives kind of all over the place now. And I think through that entire journey, it's taking I guess a lot of self-development, taking a lot of lessons, both in terms of feedback from your coaches, from how you should be doing things differently, but really being open to kind of changing the rituals and changing the processes that are open in the company. You want to keep the culture, if you will, or the kind of the values or principles you stand for, fairly consistent or close to your heart. The rituals or the sequence, the cadence of meetings, let's say, that you would have with a 10-person team is very, very different from 100%, and it's very, very different from what it is today. And that's something we had to consistently adapt. And one of the challenges, actually, I think that I had a lot of as kind of not a first-time founder, but still kind of a founder going through this kind of for the first time, this kind of hyper growth, is adapting. And just as I'm getting used to the routines that we built when we're 50 people, we're like, oh, those routines or those processes no longer work. You have to have something new. And that constant, I guess the only constant is change, right? So really much being okay with that is something that I struggle through and kind of adapted as I grew.
I can't even imagine dealing with that rate of change. And I understand that you've had 7 titles in 5 years, head of product, head of marketing, head of growth, of finance, of strategy, of business operations, and of new ventures. Have you gotten really good at selecting and training someone to replace your role so that you can step into a new one?
Yeah, pretty much. And I guess more recently, kind of like I've essentially hired myself out of a job and I'm transitioning to kind of starting something new. But my job in the company has always been a lot of that 0 to 1. Whether it's a new product or a new team, it was very much of, I was essentially the first person to start the product team, right? Or start the growth team, or start the biz ops team, and build it to a stage, find someone that could help replace me and move on to the next. And I've gotten, I guess this is applicable to anything. That is, if you kind of do it enough times, or you adapt to that, how that process works. And for me, it was a lot of how do you get something from nothing, from scratch, from 0, to a place where you then need to hand over. Kind of feels a bit like handing over your baby, handing over something that full well is in better hands in someone else's hand than it is in your own, because that person that you brought on is probably smarter, probably better at that particular function than you are, and letting go. And I think that's something that's I had to really kind of figure out how to do.
I think it's much easier said than done.
The letting go part, especially, yes.
Any tips on actually really doing the handoff?
I think I've tried different methods. And I think, again, a lot of these goes back to personal preference and kind of what whoever's listening kind of applies for them. And I would encourage kind of people to try out different things. I think one of the things that we got really good at as a company, as well as for myself, is just iterating and being okay with kind of the all these things that we try out or we do, whether it's a new algorithm or whether it's the way we kind of deploy capital or allocate resources, is just an experiment. Try it out, see if it works. It might work for someone else, but it might not work for you, and keep experimenting. And for me, the part that helped letting go the most was actually making it doing kind of a bit of a, I guess like something a bit more formal and almost like cold turkey letting it go, if you will. So having them shadow you for a little bit of time so they kind of understand what you like to do at the very least, or at least understand a lot of the context. Because I think a lot of the reasons why you would make a decision different than someone else is not because you're a better decision maker or they're not as good, but it actually comes down to context. If you believe that that person you hired is smart and capable in their own, oftentimes the reason why you would have made a different judgment call than they would have is just because you had prior history. Well, I have all the history, right? The multiple years of history, as well as they have their own different set of history, right? Of the previous companies they've worked at or different teams they're on. And that influences a lot of the judgment calls you make. And what I've come to appreciate a lot more is kind of that idea of leading by context, and a lot more of trying to tell people not what you would do, but tell people the prior history or context that that kind of comprises of the decision that I want to make. And and then I guess shadow for some time, do an official handoff, and try to just observe and try your hardest not to try to meddle afterwards.
At some point, you have to rip the Band-Aid off.
You have to rip the Band-Aid off, yes.
So what will be your new role? What do you see for the future, you and the company?
Yeah, so I think the company is in great hands. Hired a full stack of very high caliber, incredible executives that, at the start of my career, these are people that I looked up to and I wish I could work for and learn from, and I still do to this day. Well, I'm on to something new. So I recently transitioned from Clearco, from the day-to-day, still very much of an advisor and kind of supporter on the sidelines, but probably looking to build a new company. I'm not sure what that is yet.
A true entrepreneur. Can't sit in the same place for too long.
I worked myself out of a job, so finally.
Well, that's a good goal to have and a sign of success. So I like to ask all the Inspired Money guests, how do you define success?
Yeah, that's a very good question. It's something I've been thinking a lot about. And I think the younger version of myself would have just been saying to chase after a certain goal that you set. And you set the goal, but then the goal is always moving, right? So it's always hard to kind of state what that is. I think for me, the next challenge that I'm trying to figure out, or the success in my mind, at the end of the day, success to me is happiness, right? Now the question is, how do you create, or what makes you the most happy? And for me, the answer is it goes back to my roots of kind of building bots to play video games. It's like building fun projects with whether it's friends or people I really respect and like. And I want to do more of that. So I think that is a place where I find, whether it's running your own business or doing side projects on the weekends, the ability to choose your teammates, or the ability to kind of choose what to work on, has brought me a lot of happiness or a lot of joy. And that's personally what I really look forward to.
Well, you've accomplished a lot since graduation. I'm guessing that you turn 30 soon.
Soon, this year.
So you've got a bright future and you have a long time to accomplish a lot more. So thank you for sharing your business and personal stories with us. It is indeed an inspired money story because you're funding businesses that are impacting their local communities, growing the larger economy. Tell everyone where to follow you and find out more.
Yeah, for Clearco, those entrepreneurs that are out there, you can just visit the website Clearco. And for myself, you can find me on LinkedIn or Twitter, and that's Charlie C. Feng. Andy, it was such a pleasure to be here, and thank you for all those thoughtful questions.
Thank you, Charlie. So what was your favorite inspired money moment? I love the idea of democratizing capital. It's less about the team, the pitch deck, or who you know. Evaluating unit economics means Clearco is developing a repeatable investment process that works, and more diverse business owners are getting the money they need to grow. That's a win-win. If you had a different favorite inspired money moment, let me know by posting a comment below. Thank you for watching to the end. I want to invite you to subscribe to my email that goes out every 2 weeks. The Runnymede investment team highlights data, news, and events that we think are worth sharing. Subscribe at inspiredmoney.fm/newsletter. It's free and informative. Thank you for joining me on this mission. Have an inspired week and do something that scares you, because that's where the magic happens.